Kia ora, and welcome to the CoreLogic Property Market Update for May 2020. I'm back in the studio this month as it's day one of level 2, and it feels quite symbolic as we start to get back to our lives and something resembling pre-COVID-19 life. With such a prolonged period of lockdown, both in level 4 and level 3, we have a distinct lack of sales to analyse. But that doesn't mean we're going in blind to all this, as we have a variety of leading indicators of market activity. Firstly, appraisals generated by real estate agents, which provides potential vendors with a market value for their home. This is an excellent predictor of future new listings on the market, and we've seen a strong lift ever since we hit level 3 on the 28th of April. This looks to have now plateaued out at a rate that's about 20% shy of activity leading into COVID-19 restrictions and 16% below the same time last year. We do need to recognise that there has been a distinct lack of listings around most of the country for a couple of years now, so any recent surge is not going to do much to add to immediate supply. This could insulate property values in the short term, depending on the respective drop in demand. And we must also note that of the appraisals generated or new listings to market, we can't tell whether the vendor is listing due to necessity or not, which will dictate whether they're keen for a quick sale at a discounted price or not. In all likelihood, the support from both the government and the retail banks in the form of wage subsidies and reduced or deferred mortgage payments will limit stressed sales in the short term, and therefore values may hold up for now. From a demand perspective, listings portals have reported an increase in browsers of their sites. But again, it's hard to know how many will be serious buyers or just bored internet surfers. We can look to pre-mortgage activity to better understand buyer activity, with evaluations ordered by banks an excellent leading indicator of property sales. And while the banks, quite rightfully, are focused on their current customer base in the short term, they're now opening back up to attracting new customers. The lift in valuations ordered has not been as stark as the appraisals generated by agents, but it does come at a later point in the transaction cycle. And we also have to recognise level 3 was still very restrictive on the ability to sell and value homes. Further evidence of the banks wanting to do business is seen by the competitive mortgage interest rates, which are hitting the headlines now, sub 3%, partly reflecting the historically low official cash rate, as well as the long-term interest rate outlook remaining low. The Reserve Bank, of course, have played their part, with both the low OCR, which remained on hold in May, and a massive quantitative easing program, which will influence people to invest more in assets, including property. Their monetary policy statement also indicated the possibility of a further drop in the OCR, though not until next year. We have also seen the temporary removal of loan-to-value ratio restrictions. Although given the banks weren't really testing the limits anyway, we don't expect this to flow through to a significant lift in high LVR loans being written. Serviceability tests and income expense validation have been the greater hurdles for potential borrowers to overcome, and this won't change. If anything, the hurdles will be harder to jump, as the banks ensure future income of borrowers is also solid. Looking further ahead, and the economy and unemployment are the key factors to watch. Indeed, the economic outlook is very weak, with the level of GDP in late 2021 still set to be about 5% lower than pre-COVID, while the unemployment rate is expected to peak at more than 10% in the second half of 2020, on a par with levels seen during the early 1990s recession. The impact will vary wildly by region, with those employed within the food and accommodation services and arts and recreation sector feeling the pinch more than others. But it's unlikely any industries will be immune. And while long-term migration will also play a key part, we should recognise the role New Zealanders play in those numbers too. With a net inflow of Kiwis coming into the country for the first time in at least 20 years in the first quarter of this year. This is a stark difference from the average net outflow of 20,000 Kiwis in the last 20 years. And it won't take many of the up to 1 million Kiwis overseas to return home to be safe and keep those figures elevated, thus boosting demand for property. From an employment perspective, preliminary job seeker support data from MSD shows an increase in recipients, up 41% nationwide between January and April this year. That's an extra 35,000 people, and nowhere is immune. Auckland saw a rise of 56%, Wellington 43%, while Queenstown a town with local economy intrinsically linked with the success of the tourism sector, saw a ridiculous increase of 1,176%. And no, it's not a typo or misprint, although we must recognise the low base. Fewer than 40 people in Queenstown were on job seeker support prior to COVID-19. After all, if you don't have a job and aren't holidaying, what are you doing in Queenstown? Now, looking longer term, we remain focused on the support from the government to get the economy going again. And all hope will be on the rebuilding budget to get it kick-started all. But the overwhelming concern right now has to be where we're at as soon as September or October, when much of the support in terms of wage subsidies and mortgage relief are currently scheduled to end. At that point, the property market may reach a definitive fork in the road. To make sure you're on top of all the important releases of note, check out our research page at CoreLogic.co.nz. It has been absolutely bulging with content lately, including an in-depth regional vulnerability analysis. And of course, check out and subscribe to the CoreLogic Property Market Podcast for our timely take on anything to do with the property market. Stay safe. Mā te wā.